taxes. How many times have you gotten a 1099 that shows you owe taxes on a mutual fund that actually lost money? Does that not irritate you to no end? You get a bill for taxes of capital gains in a fund that lost money that year. That's because the fund manager sold investments that they purchased years ago that was very high in capital gains, and they had to pass that on to you. Folks, you have no control over this expense. If the fund manager bought GE back in the 1940s and he sells it and makes a 60% capital gains on it, that passes on to you and every other shareholder that owns that mutual fund. So a mutual fund can actually lose money and you still pay capital gains in it. But let me show you how you can gain control over that expense. How many of you have a taxable account that is down? I think everybody needs to raise their hand, and you're paying taxes on capital gains. Folks, think about it. What you need to do is realize those losses in your portfolio to offset any capital gains. If your portfolio is down, and I think everybody's is from the market we've gone through, and it's a taxable account, in other words, it's not an IRA account or a retirement account, so the taxes are going to have to be paid on it, you need to realize those losses. Folks, we can show you how to do that, how to realize your losses so you don't pay capital gains, and we can show it to you on our website, youmeandwallstreet.com. So go there and look at it and find out how to save yourself taxes, because it makes no sense to be paying taxes when you have losses in your portfolio, and yet people still do it. There's a lot more about mutual funds we're going to learn tonight, folks, because remember, we're going to build our own. But I want you to realize there are mutual funds out there that are very good, and there are mutual funds out there that will rob you blind. Now it's time for rapid fire. Put your seatbelts on, folks. Here we go.
It's time for your outspoken emails to be heard. This is Rapid Fire.
All right, folks, it's time now for Rapid Fire. This is where I take your emails that you send us by going to youmeandwallstreet.com. I read them on the air and I answer them for you, and I only have 30 seconds to do it. So let's get busy. Number one, Mr. Kiefer, I know that mutual funds have many stocks in them. My concern is that the mutual funds I am in could have companies in them I would not want to give my money to. I hold some very strong Christian beliefs, but don't know how to solve this. Sincerely, Robert M. from North Little Rock. Robert, I agree with you completely, and I'm glad you brought this up. There's actually a group of funds called socially conscious funds. These funds are made up of companies that do not compromise someone's Christian beliefs. They're out there, and they're groups. So you can look at each one and see which one you might want to pick. Now, ironically, there is a group of funds that's the total opposite, and they're called vice funds. These are funds that are full of vice-type companies like gambling, alcohol, tobacco, and things of that sort. Number two, Mr. Kiefer, I am on my 70th birthday in a few months from now, and I know I need to take money out of my retirement account. Can you please explain what I need to do and when I need to do it? Sincerely, Peggy N. from Bryant. Miss Peggy, good question. There's called an RMD, Required Minimum Distribution, and it starts when you hit 70 and a half. You have to take out a percentage of your IRA money or your retirement money. Now, fortunately, for 2009, for this year, you do not have to do it. But in 2010, if you do have to take it out, you need to know exactly how much your IRA was worth December 31st of this year, then multiply that by 3.67%, and that's the amount you have to take out. Many advisors can show you how to do that. Number three, Steve, a friend of mine had a lot of his retirement money in an investment company which had put him in closed-end funds. His story is a very sad one, and can you explain to me what these are and how they work? Thank you, Fred H. from Little Rock. Hit the clock. Fred, awesome question, and we may have to take a little bit more time than 30 seconds on this. A closed-end fund is like a mutual fund that begins, but when you put it together and build it and put it in the market, it sells like a stock. So it's not like a mutual fund. If you want to sell a mutual fund back to the company, they're required to buy it back. But a closed-end fund is not required to buy it back. As a matter of fact, they don't buy it back. They build it, they throw it out there, it's traded on the secondary market. So Steve, what's the problem? The problem is you have to have a buyer, folks, before you can sell that closed-end fund. Now, there are people that make markets in like Walmart or Microsoft, so you're always going to have a buyer for those kind of stocks. Closed-end funds are what we call traded on a thin market, which means you may not have any buyers and you could be stuck with that closed-end fund literally forever. So be careful when you hear the word closed-end fund. I'm not saying no, I'm just saying be careful, be alert, be aware so you don't get taken. Number 4, dear sir, can you explain on your TV show about ETFs? Are these something I should own? Thank you for your help on this. Arthur T. from Conway. Arthur, great question and good timing because we talked about that a little bit today. ETF stands for Exchange Traded Fund. It's a fund that basically mirrors an index. And we'll use one that we all know, the Dow 30. You would buy an ETF that had the exact same stocks in it that the Dow does, and the exact same amounts. Now, they trade like a stock. Unlike what I just said about a closed-end fund, ETFs are pretty much liquid, so you can buy and sell them all the time. But you'll pay a commission to buy it and pay a commission to sell it. You can get index funds in a mutual fund form that could actually be no load, so there's no cost to buy or sell, but that's the difference. Folks, if you want to send us an email and let me answer that on the air for you, then you've got to do this. Robert, tell them what it is.
If you have an investment question or comment you would like answered on air, send those emails to rapidfire@youmeandwallstreet.com.
Folks, I want to finish up our discussion about expenses with number 6, and that is the spread. Now, let me see if I can explain this as simply as possible. Let's say we have 2 stocks that are $50 a piece, ABC and XYZ. And you've got an ETF or exchange traded fund that mirrors the S&P 500 that has this stock in it. And the S&P 500 decides they're going to sell this stock. Well, now every exchange traded fund on the planet is going to have to sell that stock to stay exactly the same as the S&P. Now what that means is they are going to sell, let's say they're going to sell 500,000 shares of ABC stock when you add up all the ETFs together. That's a huge amount of shares. The first few shares they might get $50 for, but as these shares flood the market, it's going to drive that price down. They might get $46 for some, $44 for some, and so on and so forth until they're all sold. Now, they turn around and buy XYZ, the exact opposite's going to happen. Now this thing is in such demand, it's going to drive the price up. So they're going to pay $51, $52, say $56 when they finally get done. The spread is the difference. This is $6 below what the original price was. This is $6 above what the price was. The spread is $12 per share. That means they paid $12 more to exchange these funds or these stocks than you and I would if we bought 100 shares of them and it didn't affect the market at all. This is an expense here, folks, that you have to watch out for, and you'll probably never see it. But just realize, again, these funds that turn over a lot, that's going to happen to you. So watch out for those. Now, how do you know all this? Steve, how can I find out if my fund is turning me over many, many times and what it's costing me? Here's how you do it. Right now, go to youmeandwallstreet.com. Go to our website right now, send us an email, and send us the ticker symbols of your mutual funds. It'll always be 5 letters, and they always end in X. And I will send back to you the exact cost that you're paying on those mutual funds. Do it now, folks. All right, folks, let's get our tool belts on and let's build our very own mutual fund. I'm going to show you how a mutual fund comes into existence. And we're going to name our mutual fund after our show. You, me, and Wall Street, and we always put an X there. So our mutual fund is YMAWX. Now I'm going to make it real simple. There are basically 3 components. There are more, but we're going to boil it down to 3. 3 components that we need for this building. The first one is the foundation, and that's the objective. What is this fund going to do? Is it going to be a bond fund, a stock fund? Let's say we're going to make this a large cap growth fund. That's our foundation. So we're going to look at companies that are very large in size, that are outpacing their peers. They're growing faster than their peers are.